Look at any standard price chart during an active trading session, and you will see a constant stream of broken support levels and false signals. Entering a position based on a single trigger, like a price touching a trend line, often leaves you exposed to sudden reversals. Institutional traders rely on confluence. They look for specific price zones where multiple independent analytical tools point to the exact same outcome. We are going to build a specific framework that stacks the odds in your favor using 3 distinct tools: the Ichimoku Cloud, Fibonacci Retracements, and Volume Profile. Go ahead and open your preferred charting platform. We're going to layer these tools onto a chart step by step so you can see exactly how they interact. Moving from single indicator guessing to a layered mechanical system gives you a verifiable edge in these noisy markets. This chart shows an uptrend with the Ichimoku Cloud acting as a dynamic boundary. Our baseline rule: we only evaluate buying opportunities when price is comfortably above the cloud, confirming buyer control. However, rallies eventually pull back. We must identify where this dip finds support. Knowing the trend is useless if you buy at the absolute peak. The cloud gives us our baseline, but we need a more precise measurement to navigate the retracement. To measure the pullback, we apply Fibonacci retracements. These mathematical ratios help us identify where a corrective move is statistically likely to stall. Drawing the Fibonacci tool from the swing low to the rally's peak generates key grid lines. Focus on the 50% level. It perfectly intersects with the upper boundary of the Ichimoku Cloud. 2 independent metrics now point to the exact same price level. 2 overlapping indicators create a strong thesis, but a thesis requires actual capital to work. We need proof that large-scale buyers are actually interested in defending this specific zone. Standard volume bars at the bottom of a chart measure transactions over time. Volume profile maps those transactions to price. By plotting transaction density horizontally, volume profile creates a permanent historical map of where large institutions have previously accumulated heavy positions. On the right, the volume profile histogram reveals where shares changed hands. The longest bar is the point of control, while surrounding clusters form high-volume nodes. Our largest high-volume node projects straight into our targeted zone, perfectly aligning with the Fibonacci and cloud. Trend structure, geometric retracement, and historical liquidity all intersect in this exact location. We have found a high-probability confluence zone. The most common mistake traders make is placing a blind buy order the moment the price touches this zone. The area is a point of interest, not a guarantee. As price drops into our confluence zone, we wait for a definitive bullish candlestick pattern, like this hammer. The long lower wick shows that sellers tried to push price through the bottom, but aggressive buying immediately stepped in to force it back up. Once that confirmation candle officially closes, the setup is complete. You place your buy order. You then secure the trade by placing a strict stop-loss order slightly below the lowest edge of the entire confluence zone. If the price breaks through that floor, the thesis is invalid, and you exit the trade. To calculate your target on this chart layout, measure the distance to your stop-loss and set your take profit at the previous swing high. This specific structure guarantees a risk-to-reward ratio of at least 2-to-1. By defining your maximum loss and required profit before entering the position, you remove emotion entirely. You are executing a calculated business decision. With the parameters set, the market does the rest. The price cleanly rejects the confluence zone, catches the underlying momentum, and drives upward to hit the profit target. Losses are inevitable in any market environment. No strategy wins every time. Professional trading is simply about consistently placing capital into situations where the mathematical probabilities are skewed heavily in your favor. Identify the trend with the cloud. Locate the pullback with Fibonacci. Confirm institutional interest with volume. Act when price confirms the setup. Before you risk real capital, open your charts. Scroll back through historical data and find 3 distinct examples of this exact setup. Test the logic yourself.